The Fed just cut rates, and the markets are on fire. But how long will this party last? In this video, we'll unpack the recent market reactions and, more importantly, reveal how much time we really have before the next big crash. I've spent weeks analyzing data, studying historical patterns, and tracking key indicators to bring you this critical information. From the S&P 500 surge to the Dow Jones's climb, we're seeing green across the board. But here's the kicker. This bullish trend has an expiration date. Stay tuned to find out exactly when the music might stop. Let's dive into why the markets are so bullish right now. We're seeing a perfect storm of positive signals. First, the US dollar index is trending down. This might sound bad, but it's actually great for stocks. Why? Because it makes US stocks more attractive to foreign investors. Next, oil prices are falling. Cheaper oil means lower costs for businesses, which can boost their profits. Finally, we're seeing a drop in 10-year Treasury yields. This typically pushes investors away from bonds and into stocks. It's like all the traffic lights turned green at once for the stock market. But remember, green lights don't last forever. We need to keep a close eye on how long these bullish conditions persist, because they're giving us crucial clues about the timing of the next downturn. Now, let's talk about the three key indicators that are practically screaming at us right now. First up, we've got the yield curve. For months, it's been inverted, which is like an economic warning light. But recently, it flipped back to normal. This flip is a big deal. It's often the starting gun for a countdown to recession. Next, we've got the federal funds rate. The Fed just cut it for the first time in ages. Historically, when the Fed starts cutting after a series of hikes, it's like the economy's check engine light coming on. Finally, there's the unemployment rate. It's been incredibly low, which sounds great, right? But here's the twist. We're starting to see a slight uptick. This could be the first tremor before an economic earthquake. These three indicators together are like a crystal ball for the markets. They're telling us that yes, we're in for more upside, but they're also whispering a warning. The clock is ticking. The question is, how much time do we have left on that clock? That's exactly what we'll uncover next. Let's take a trip down memory lane and see what history can tell us about our current situation. In the past, when we've seen these three indicators align like they are now, it's been like a roller coaster reaching its peak before the big drop. But here's the interesting part. The market doesn't immediately tank. Instead, we typically see a period of continued growth. It's like the calm before the storm, or the last hurrah before the party ends. Looking at previous cycles, this bonus bull run has lasted anywhere from 1 to 6 months. That's right, half a year of potential gains before things get rocky. But don't get too comfortable. Remember the 2008 financial crisis or the 2020 COVID crash? They both followed similar patterns. The key takeaway here is that while history doesn't repeat exactly, it often rhymes. And right now, it's rhyming with some pretty significant market turning points. So, what does this mean for us today? Well, that's exactly what we're about to dive into next. Now, let's talk about the elephant in the room. How much time do we really have? Based on our analysis, we're looking at a window of 1 to 6 months. But why this specific time frame? It all comes down to market psychology and economic mechanics. When the Fed cuts rates, it's like injecting adrenaline into the market. Investors get excited, and stocks typically rally. But here's the catch. Rate cuts also signal that the Fed sees trouble ahead. It takes time for this reality to sink in, and for economic data to reflect the slowdown. During this period, we often see a last gasp rally. It's like the market's final party before the hangover kicks in. The 1-month minimum comes from the typical lag in economic reporting. The 6-month maximum? That's based on how long it usually takes for rate cuts to fully impact the economy. Remember, this isn't a precise science. Markets can be unpredictable, but this 1 to 6 month window gives us a crucial heads up. It's our chance to prepare, to maximize gains, and to set up our defenses before the tide turns. So, what should we do with this information? That's exactly what we'll cover next. Let's talk numbers. Where could the market peak before the big drop? For the S&P 500, we're looking at a potential high of around 5,200 to 5,400 points. That's roughly a 10 to 15% increase from current levels. As for the Dow Jones, our analysis suggests it could reach the 38,000 to 39,000 range. These aren't just random guesses. They're based on technical analysis, historical patterns, and the current economic climate. But here's the kicker. Reaching these levels doesn't mean it's time to celebrate. In fact, it's quite the opposite. These peaks could be the last hurrah before a significant correction. We're talking about the potential for a 50% drop from these highs. That's right, the market could essentially cut in half. It's a sobering thought, but it's crucial to keep in mind as we navigate these choppy waters. So, how can we use this information to our advantage? That's what we'll cover in our final and perhaps most important section. So, how do we play this final act of the bull market? First, don't panic. We've got time, but we need to be smart. Consider taking some profits off the table as we approach those peak targets. But don't cash out entirely. Remember, there's still potential upside. Diversify your portfolio. Look into defensive sectors that tend to weather downturns better, and start building a cash reserve. When the correction comes, it'll be a buyer's market, and you'll want to be ready. Now you might be thinking, wait a minute, didn't you just say the market's going to crash? Well, here's the thing. Markets are complex, and timing is everything. In fact, in my previous video, the stock market is going to rise strongly, believe it or not. I broke down why we're likely to see significant growth before any downturn. From upcoming Fed decisions to tech sector opportunities, there's a lot of bullish indicators you need to know about. If you haven't watched it yet, check it out next. It'll give you the full picture and help you make the most of this market, whether it's going up or down. Remember, knowledge is power in investing, and right now, you need all the power you can get.